As the global economic landscape continues to evolve, the tensions between the United States and China remain a focus of intense scrutiny. In late 2024, President-elect Donald Trump's policies have resurfaced, as his administration's plan to impose an additional 10% tariff on all imports from China has gained renewed attention. If you are new to our channel, please leave a like as well as a sub so you never miss out on any of our future videos. This proposed tariff would build upon the existing duties established during Trump's first term, which were aimed at addressing what the U.S. government perceived as structural challenges in its trade relationship with China. The latest round of tariffs would encompass a wide range of products, including consumer electronics, machinery, textiles, and other critical imports that play a significant role in U.S.-China trade. These measures are positioned as part of a broader U.S. strategy to address economic and strategic concerns, including trade imbalances and supply chain vulnerabilities. If enacted, this policy shift could significantly impact the dynamics of U.S.-China trade, with potential consequences for both economies and global markets. The U.S. government has long expressed concerns about the trade deficit with China, which exceeded $300 billion in 2023. The Trump administration views this as a structural challenge, believing it reflects uneven trade dynamics that may disadvantage U.S. industries. Additionally, U.S. officials have emphasized the importance of fostering a level playing field for businesses, as they believe China's domestic policies, including state support for key industries, have created competitive challenges for American companies in the global market. The proposed tariffs aim to encourage domestic production and reduce reliance on imported goods. The U.S. sees reducing dependence on imported goods, particularly in critical sectors such as technology and infrastructure, as essential for economic resilience and national security. Officials have highlighted the need to diversify supply chains and prioritize domestic manufacturing as a safeguard against potential vulnerabilities. Tariffs are seen as one component of a larger strategy to secure supply chains and ensure that critical industries are less exposed to external risks. The reimposition of tariffs, as indicated by recent political developments, is expected to have a significant adverse impact on the U.S. economy, with American agriculture poised to bear the brunt. Farmers, already struggling to regain market share lost during previous trade disputes, face increasing competition from Brazil and other countries that have capitalized on the void left by the U.S. in critical agricultural markets. During Donald Trump's first administration, a trade war with China resulted in a sharp decline in American agricultural exports, particularly soybeans. Exports to China, the world's largest soybean importer, fell by 79% in the first 2 years, causing an $11 billion loss for American soybean farmers. While financial aid to farmers mitigated some immediate effects, the structural damage to market relationships was profound. China has since diversified its import sources, turning primarily to Brazil, which has emerged as a dominant player in the global soybean market. Brazil's rapid expansion of soybean acreage, combined with infrastructural improvements, allowed it to fill the gap left by U.S. exporters. This shift has also encouraged China to diversify its supply chains for other crops, reducing its reliance on the U.S. for corn, wheat, sorghum, and cotton. The potential reintroduction of tariffs under similar policy frameworks threatens to exacerbate existing challenges. China, once heavily reliant on U.S. soybean imports, has established Brazil as its primary supplier over the years, clearing significant portions of land to meet growing demand, with a projected harvest more than 30% larger than pre-2018 levels. Brazil is set to dominate this market. In addition to diversifying its supply chain, China has also built record stockpiles of soybeans, granting it greater independence from U.S. agricultural exports. The low global prices of soybeans have squeezed profit margins for American farmers, and while domestic soybean demand has grown, it is insufficient to offset the significant export losses caused by trade disputes. Tariffs will likely exacerbate this, forcing many smaller-scale farmers to consider alternative crops or risk financial insolvency. The challenges extend beyond soybeans. In recent years, China has approved corn imports from Brazil in 2022 and Argentina in 2023, signaling its intent to diversify away from U.S. dependence. Argentina's authorization marked the first major corn and wheat shipments to China in decades, reducing China's reliance on American grains. Brazil's growing corn exports have capitalized on this shift, particularly as Chinese feed mills now see Brazilian corn as a viable and competitive alternative. U.S. corn exports to China, which had been reaching record levels, are now at risk of significant declines. Wheat faces similar challenges, with U.S. exports becoming less competitive as South American suppliers grow their presence in China. For many American farmers who rely on exports to stabilize prices and clear surpluses, these changes could lead to unsold inventories, lower prices, and reduced income. Sorghum, another key U.S. agricultural export, has also been affected. U.S. sorghum producers have historically depended on China, the largest consumer of the grain, which uses it for livestock feed and in the production of the liquor baijiu. Over 70% of U.S. sorghum exports go to China annually. However, Brazil's emergence as a sorghum producer, with an output of 4.6 million tons, is reshaping this dynamic. If tariffs are reimposed, China is likely to accelerate its pivot to Brazilian sorghum, further reducing U.S. exports, disproportionately affecting sorghum growers who have few alternative markets capable of absorbing the large quantities that currently go to China. The global pork trade has also undergone significant changes. While China has been a robust market for U.S. pork, changing dietary habits in China are reducing overall pork consumption. Chinese consumers are increasingly favoring proteins like poultry, beef, and seafood. Even without a trade war, this shift poses a long-term challenge to U.S. pork exporters. In recent years, China has expanded pork imports from Brazil, leveraging its cost-competitive production. As tariffs push Chinese buyers further away from U.S. pork, Brazil stands ready to fill the gap, intensifying competition for American producers. The global cotton trade has also seen substantial shifts since the 2018 trade war. China has bolstered its cotton reserves and increased domestic production. Additionally, Brazil and Australia have expanded their market share in China, with Brazil overtaking the U.S. as the top cotton exporter in 2023 to 2024. U.S. cotton, long considered the gold standard for quality, remains highly sought after. However, the added costs from tariffs make American cotton less competitive in price-sensitive markets. A weaker Chinese economy and declining demand for textiles further exacerbate the problem, creating a challenging environment for U.S. exporters. China has effectively used its participation in the Brics coalition, comprising Brazil, Russia, India, China, and South Africa, to diversify its sources of critical imports. In the energy sector, partnerships with Russia and Brazil have secured stable supplies of oil, gas, and other resources, reducing China's reliance on traditional suppliers in North America and the Middle East. Similarly, China has turned to Brazil and South Africa for agricultural imports, including soybeans and meat, ensuring food security and mitigating the risks of supply disruptions from other countries. By strengthening trade ties within Brics, China has opened up new markets for its exports. The country has focused on infrastructure projects and technology exports in Brics nations, enabling it to tap into rapidly growing economies. Additionally, Chinese manufacturers have expanded their customer base for goods such as electronics and machinery, effectively offsetting reduced demand from the U.S. due to tariffs. These export relationships have bolstered China's manufacturing sector and provided steady economic growth opportunities, mitigating the impact of tariffs and sanctions. The imposition of U.S. tariffs on Chinese goods initially posed challenges, but China has successfully mitigated their effects through trade realignment. Brics partnerships have allowed China to redirect its trade flows, replacing lost markets in North America with increased activity in partner nations. For example, Brazil has become a major supplier of agricultural products, while Russia has provided energy security. These alliances have also enhanced China's supply chain resilience by reducing its dependence on single sources for critical inputs. Rather than hindering progress, U.S. tariffs and sanctions have prompted China to strengthen its economic relationships with Brics partners, fostering a more resilient and diversified economy. By leveraging its position within the Brics framework, China has not only maintained but also enhanced its economic trajectory, ensuring continued growth even in the face of restrictive trade measures. These efforts have solidified China's role as a global economic powerhouse. U.S. agricultural policies, particularly the imposition of tariffs, have far-reaching effects on both domestic farming operations and global trade dynamics. These policies influence input costs, export competitiveness, and the realignment of global markets. Tariffs on imported goods, such as steel and aluminum, directly impact the agricultural sector by increasing the costs of essential inputs like machinery and equipment. The trade conflict between the U.S. and China initiated in 2018 led to tariffs on these materials, resulting in higher prices for agricultural equipment manufacturers. These elevated input costs were subsequently passed on to farmers, raising overall production expenses. Retaliatory tariffs imposed by key trading partners have diminished the competitiveness of U.S. exports. A study by the U.S. Department of Agriculture found that retaliatory tariffs reduced U.S. agricultural exports by $27 billion from mid-2018 to the end of 2019, with soybeans accounting for 71% of this decline, followed by sorghum and pork at 7% and 5%, respectively. These tariffs incentivize importers to source commodities from alternative suppliers like Brazil and Argentina, which can offer similar products without the added costs associated with tariffs. The imposition of tariffs has prompted a realignment in global agricultural trade flows. Countries such as Brazil, Argentina, and Australia have expanded their agricultural sectors to fill the void left by reduced U.S. exports. China's pivot away from U.S. agricultural imports since 2018 has bolstered its food security against potential trade tensions, as it has increased imports of grains from Brazil, Argentina, Ukraine, and Australia, significantly decreasing the U.S.'s share in China's soybean and corn imports. This shift not only diminishes the U.S.'s role as a leading exporter but also strengthens the market positions of these alternative suppliers. The United States' imposition of tariffs on countries beyond China, such as Canada, Mexico, and European Union member states, has significant repercussions for the U.S. economy. These tariffs can lead to increased consumer prices, disruptions in supply chains, and retaliatory measures that collectively hinder economic growth. Tariffs function as taxes on imported goods, and the additional costs are often transferred to consumers through higher prices. President-elect Donald Trump's proposal to impose a 25% tariff on imports from Canada and Mexico, along with an additional 10% on Chinese imports, is anticipated to elevate prices for American consumers. Goods such as fresh produce from Mexico, lumber from Canada, and electronics from China would become more expensive, directly impacting household budgets. Estimates suggest that these tariffs could raise U.S. consumer prices by 0.75%. resulting in over $1,000 in lost purchasing power per household. The U.S. economy is deeply integrated with global supply chains, particularly with neighboring countries like Canada and Mexico. Tariffs on imports from these nations can disrupt established supply networks, leading to inefficiencies and increased production costs for U.S. businesses. For example, the automotive industry relies heavily on parts manufactured across North America, and imposing tariffs on Canadian and Mexican imports could increase production costs, potentially adding around $3,000 to the price of a new car, affecting both manufacturers and consumers. Proposed U.S. tariffs on China risk further trade tensions, impacting American agriculture, manufacturing, and retail. Diversification efforts by China within Brics have mitigated initial effects, but broader economic implications loom, including higher consumer prices and supply chain disruptions. Stable, predictable trade relationships are crucial for long-term prosperity. Thanks for watching till the end. If you enjoyed this video, please leave a like as well as a sub so more people can see this.